In today's episode, we're going to do a deep dive into penny stocks. I'm going to walk you through what penny stocks are, how to find the best penny stocks to buy, where to get in, where to get out, and the strategy that I've used to find consistency. Everything I share with you today comes from my own experiences trading the market. As you may know, my name's Ross Cameron. I turned an account with less than $600 into more than $10 million in verified and audited profits, and I did a lot of that trading low-priced stocks. I want to remind you, as always, my results are not typical, but my experience has put me in the unique position to share with you not only what is working in today's market, but where retail traders like you and I still have an edge. As you may know, I'm in the middle of a small account challenge, and because we crossed over 10,000 new subscribers, I reset my account back to $1,000. So today is day one of trading with $1,000, and today I'm gonna buy a penny stock. Let's dive right in and jump on the screen share. I'm about to buy 5,000 shares of a penny stock right now that is up nearly 70% on the day with over 33 million shares of volume. This stock has news, it is moving higher, and in fact, it is one of the leading percentage gainers in the entire market. So I am now in the trade with 5,000 shares, but hold on, let's step back for a second. I think we need to play a little catch up before you could fully understand why I chose that stock, why I got in at 20 cents a share, even though it's already up 70% on the day. I need to walk you through how penny stocks work because they are not like regular stocks. This is a beginner's guide to trading penny stocks. Okay, so penny stocks officially, according to the Securities and Exchange Commission, are stocks under $3 a share. I think it's kind of funny that they call stocks under $3 a share a penny stock, because from a literal definition, a stock trading at $1 or $1.50 or $2 is not a penny stock. A penny stock should literally be a stock that is priced less than $1. So that would be my traditional definition of a penny stock, but the official definition is that any stock under $3 a share is considered a penny stock by regulators. So since I focus on trading stocks between $1.50 and $10 and as high as $20, I am from time to time trading, well, the official definition of a penny stock. Now, one of the big differences between stocks above $1 and below $1 is something called the tick. So a stock above $1, and this is going to make a lot of sense to you, will trade down to the minimum of 1 penny spread. The way this works, let's jump onto the whiteboard, is a stock at $1.50 could be $1.50 on the bid and $1.51 on the offer. Every stock at all times has a bid and an offer. When people talk about the price of a stock, usually they're referring to the last price, which is the last order that went through. But all stocks have a bid and an offer. So in the case of any stock over $1, the minimum spread, the tightest it could ever be, is 1 penny, right? 1 penny, right? Just like that. Because you can't have a stock that trades $1.50 and half a penny or something like that by $1.50 and 3/4 of a penny. That would be insanity, right? Yeah, it would be. And yet, what's wild is that penny stocks trade down to the 1/100th of a penny. It's true. So let's look at the screen share. If we look right here, you will see that this stock is actually trading. There's after the decimal point, there's 4 characters. It goes 4714. So if the stock only went to the 10th of a penny, it would be 471. And it would go 471, 472, 473, 474, so on and so forth. But it actually goes down to the 1/100th of a penny. So this penny stock right now is trading with a spread of 0.4714 by 0.4719. This is pretty wild. And so something that I'll share with you is that for a stock to go from $1 to $1.10, how much does it have to go up? 10 cents a share, right? And how many pennies is that? It's 10 pennies. And so there are actually just 10 increments between $1 and $1.10. there's 101, 102, 103, et cetera, until you get to $1.10. What about a stock that's at 90 cents a share? 90 cents to $1 a share. Well, how many pennies is that? It's 10 cents, the same. But it is actually 1,000 increments. And that's because each penny can trade down to the 1/100th of a penny. So you do that 10 times, 100 times 10 is 1,000. That's not 1,000 lines, but you get the idea. So what that means is that typically penny stocks will not move as quickly between 90 cents and $1 as they will once they cross over $1 a share. So a stock will move infinitely faster from $1 to $1.50 than from 50 cents to $1. 50 cents to $1 is, oh my God. So you've got 1,000, that's 5,000 increments of price. 50 cents times 100 to the 100th of a penny. That's a lot of resistance it has to move through before it can hit $1. But from $1 to $1.50 is only 50 price increments. So 5,000 versus 50, that's insane. And that's the difference when a stock crosses $1 a share. Okay, so I prefer stocks over $1 a share because they move faster. But a lot of traders do gravitate towards these lower price stocks for the obvious reason that they're cheap, they're affordable. And I understand because I fell into the same category and I was thinking the same way when I began trading. For me, it actually began with a friend in high school who made $16,000. Now, this was an incredible amount of money. I'm not going to date myself by just telling you when I graduated, but it was long ago enough that this was a lot of money. And with the $16,000, he bought a used Nissan Pathfinder. He bought an arcade machine. He had a big screen TV and a fantastic stereo system in the basement of his mom's house. This kid was living the life. So when my friend Ben made that $16,000, he did it trading a penny stock. And he had not a lot of money, but he bought a lot of shares of a low price stock and it went up a ton. So when I got into the market when I was in my 20s, I didn't have a lot of money, so I naturally assumed I should buy penny stocks. It worked for Ben, it'll work for me. So what I started doing was Googling penny stocks to buy. And invariably, I ended up finding a lot of these websites that were pumping different penny stocks. Most of these website owners were most likely either compensated directly by the company for promotional campaign around the penny stock, or they were actually holding shares of the penny stock secretly. And as soon as it starts to go up, they're unloading and they're selling. So one of the things that I learned early on is that penny stocks can be very risky, but it's also true that not all penny stocks are exactly the same. So let's talk a little bit more about the different types of penny stocks. First of all, you have penny stocks that are listed on the NASDAQ and the New York Stock Exchange. Now, what's interesting here is that both exchanges require companies to keep their stock priced above $1 a share in order to maintain compliance. That's the minimum price. And yet, you've probably seen on many days, including today, me trading a penny stock that was priced less than $1, but it's listed on the NASDAQ. How does that work? Well, just because the stock dips below $1 a share doesn't mean the company is immediately banned from the exchange. They have a period of time in order to get their price back up above $1. So the stocks that are listed on the exchange that are also penny stocks, generally these are companies that used to be priced higher but have declined in value. They've gone through a period of struggling, and the hope for investors or traders like myself is that it's a turnaround story. This is a stock that's about to turn around and will no longer be a penny stock. However, if they are not able, just through the merits of being a better company, get the stock price back above $1 a share, they will do what is called a reverse stock split. Let me show you on the whiteboard what that looks like. So you have a stock that's maybe IPO'd at $10 a share or something like that, and it declined in price all the way down to, let's say, 20 cents. All right, it's 20 cents a share. It is no longer in compliance, and they can't get the stock to go higher because it's just not a good company. And so they want to maintain their listing on the New York Stock Exchange or NASDAQ. So what they do is a 10-to-1 reverse split. And the next day, the stock is priced at $2 a share. Now the chart doesn't go like this. Well, it wouldn't go all the way up there. The chart doesn't jump back up to $2 a share. The chart stays exactly like this, except this changes from 20 cents to $2. And this, of course, goes from $10 to $100. So the whole chart gets adjusted when a reverse stock split occurs. Now, stock splits can happen both as reverse splits and traditional splits. A traditional split is when a $100 stock becomes 10. The reverse split is when the $10 stock becomes 100. So here you have what is very common. The stock does a split, it goes up to $2, and then the decline can continue. And then they might do another split. It goes down to 20 cents again, and they do another split, another 10 to 1 split. And now this is $2, and this over here becomes $1,000. So the stock chart keeps essentially going lower and lower and lower. So with many penny stocks, it feels like there is no end to how low they can go, which makes it pretty risky. And you do not want to be a bag holder. A bag holder is someone who's holding and hoping it's going to turn around, but they can keep going lower and lower and lower. They make it so it doesn't go to zero. There's a new low, a new low, a new low. But something else happens when these splits take place. The number of shares available to trade changes. So let's just say you were holding 10,000 shares of this stock at 20 cents a share, and the next morning you log in and it's at $2. You'd be thinking, oh my gosh, I'm up 20 grand. This is awesome. And then you realize, wait a second, I'm not holding 10,000 shares anymore. I'm only holding 1,000 shares. And that's because that's the trade. So you're still holding the same dollar amount value of stock, but the number of shares have gone down. There's a relationship in trading called, well, it's not just in trading, but supply and demand. Supply in trading is the number of shares available to trade, and this is called the float. So when a company does their initial public offering, you have the float, and from that point forward, that's the number of shares available to trade. On the demand side, we have a stock that has news, as the stock I traded today had. We have a stock that is up, 50% or more. This is an indicator of high demand. You have a stock that has super high volume. High trading volume is an indicator of high demand. You have a stock that's priced between 10 cents and $20 a share. This is a price range that's going to be popular among retail traders. When you have all of these characteristics of demand, you have high demand combined with a limited level of supply. So a penny stock that may have initially had a float of 10 million shares, when they first IPO'd, after the first split, the number of shares goes down to 1 million. And then after the second split, the number of shares goes down to 100,000. And all of a sudden, you can have a massive imbalance between supply and demand. And that's how a stock goes from 20 cents to 40, 50, 60 cents a share, maybe even higher. In fact, we just yesterday saw a penny stock that went from about 15, 20 cents a share, I'll show you the chart in a moment, all the way up to over $1.50. And it happened within about an hour. This is an incredible move, an incredible opportunity. And it wouldn't happen if it weren't for this imbalance between supply and demand. Okay, so it's important to understand that the penny stocks that I'm going to choose to trade are stocks that are listed on the New York Stock Exchange or NASDAQ that started at a higher price, but then began a long decline down. Typically, some of the best penny stocks to trade will be stocks that had a series of reverse splits, which made the level of shares available to trade, the float, very, very small. Which means on that one day that the company finally comes out with great news, the stock can explode. But that's not the only type of penny stocks that you could trade. We also have what are called OTC stocks. This is the over-the-counter market. OTC stocks are much, much riskier for me, in my opinion, and it's not something that I want to trade. If you saw the Wolf of Wall Street movie, the type of penny stocks that they were pushing on people were pink sheet stocks, which is the lowest tier of the OTC market. The OTC market is actually broken down into tiers, which does help you better understand the level of risk involved with trading them. The OTC best market, these are the stocks that face higher financial standards and they have to demonstrate compliance on multiple fronts. Then there's the OTC venture market. venture market stocks have to be priced at least at 1 penny, which, you think 1 penny is setting the bar quite low. But remember when I told you a stock can trade down to the 1/100th of a penny? That means, in fact, a penny is not the lowest price a stock could go to. The lowest price a stock could go to would be literally just 1/100th of a penny. This is called a trip zero stock. And it's called that because there are 1, 2, 3 zeros. All right, so that's the very worst. So the OTC venture market, well, hey, this is not so bad. The stocks, they have to be at least 1 penny a share, and they can't be in bankruptcy. We often see NASDAQ and NYSE listed stocks that go into bankruptcy. When they go into bankruptcy, they get moved right to the OTC market, and they go to the pink sheet market, which can be a stock that is in bankruptcy. So sometimes you'll hear about a stock that's in bankruptcy that people are still actively trading, and it can be confusing. How do you actively trade it? Well, the OTC market allows these companies to continue to have their stock listed, and people can continue to buy and sell in hopes that maybe the company will come out of bankruptcy. The problem with that is that a lot of times the restructuring negates any investment or value of shareholders. So shareholders usually lose when it comes to bankruptcy. But in any case, the bottom of the OTC market is called the pink sheets, the open market. This is the rest of the OTC stocks that don't meet the criteria for best market or venture market. And one of the problems with pink sheets is that these companies do not face the same financial reporting requirements, certainly as the venture market or the best market, but not even close to a NYSE or a NASDAQ listed stock. The problem here is that the true ownership and the true profitability of a company may not be clear to a potential investor. And that's why those companies have been used in the past as vehicles for pump and dump schemes. And that's something that we want to avoid. So if we look at the next slide, this is an example of a stock I would never, ever trade. This is a trip zero stock. It is the very bottom of the barrel. And you can see that this is a stock that the chart is not even valid. It's just sideways. But you could also understand why if someone owned, 1 billion shares of this stock at let's just, do the math here on the whiteboard. If they owned it at 0.0001 and then they were able to sell it at, 0.001, all of a sudden like that, they're making a huge multiple, and that's where there's a lot of profit. So this is the problem with these low price stocks, is that people will buy a ton of shares, and even just a small move, they can make a lot of money, which means when they do a pump and dump, they only need to get the stock to go from 0.0001, even just from there to 0.0005, it's up 500% off the low. This is a move that could be making someone a lot of money. All right, so you're never going to see me trading a trip zero stock. Trip zero stocks, we don't touch them. A sub penny stock is a stock priced below 1 penny a share. I'm not going to trade these either. These are stocks, they're below a penny. So on the level 2, or the price is going to be 0, 0, 2 zeros, and then, 0.003 by 0.004, something like that. Or, it could go down to the 100th. So I'm not going to trade stocks like that either. These are not going to be stocks that are listed on NASDAQ or NYSE. At this point, when they're below a penny, they get delisted and they get pushed to the OTC market. So we're not going to trade those. The type of stocks that I'm willing to consider trading, the type of penny stocks that I'm okay with, are penny stocks that are priced generally, well, it's got to be a 1 penny minimum for me, but generally 10 cents or higher is kind of like my minimum cutoff. And the stock has to be listed on the NASDAQ or the New York Stock Exchange. Those are steps that I take to reduce my risk. Because here's the deal. I want to be able to make money. I'm a hunter of volatility. I want to trade something that has the potential to go up 50%, 100% or more. But I don't want to risk losing everything I've put into the trade. So the way I do that is by buying stocks that are liquid. Liquid means I can easily get in and I can easily get out without losing a lot of money. So if we jump back onto the whiteboard, or rather the screen share, let's look at this trade from this morning. Okay, so I'm in with 5,000 shares. This is a stock that is listed on the exchange. It's not an OTC stock, so that's great. That's the first thing we can feel good about. And it's priced at about, 20 cents a share. Now, as you can see right now, I'm not showing or displaying the 4 decimals. And that's why it actually looks like it's a crossed market. It's 22 cents by 22 cents. But that's just because of rounding. I choose not, in this case, I chose not to display all 4 cents for the beginning of this episode. I end up showing it to you a little bit later in this clip, which you'll see in just a moment. Okay, so the reason that the way I was able to select this stock was because I'm using a scanner, which you can see right here. This is my penny top gainer scanner, and it is searching the entire market for penny stocks that are moving up more than 10%. That's just the minimum cutoff for me. I want to see that the penny stock is moving up at least 10% because that for me indicates that we've got, what were we looking for? A high level of demand. Now, certainly up 50% is better. My approach is that I want to focus on the penny stock that is up the most on any given day. And the reason is because the penny stock that's up the most on any given day is going to have a lot of traders watching it. There are so many retail traders like myself, and especially who are beginner traders with smaller accounts that only trade penny stocks. So when I was getting started, when I got into trading in my 20s, I said, all right, I'm going to focus on penny stocks. And I realized pretty quickly I had to stay away from the OTC stocks. So I wasn't going to trade anything that was a sub penny or a trip zero stock. I was only going to be trading things at least above 1 penny a share, and preferably, at least at 10 cents a share. And I'd look to essentially each morning scan the market and search the market for which penny stocks are moving today. What is today's hot stock? So this is the scanner that I use to make that search. What this is going to do is it's going to search the entire market for any stock that is within the parameters of the filters that I've set. So I'm searching for stocks up at least 10%. And in this case, I'm searching for stocks that are under $3 a share. So that makes it a traditional penny stock. Now I have other scanners that I use to search for the type of stocks that you'll typically see me trading, stocks between $2 and $20, for instance. But for the sake of this challenge, I wanted to test myself by only trading penny stocks. So NSTG is the leading percentage gainer today. And although there is a penny stock that has more volume, this one that's GGE, the problem with it is that it's only 5 cents a share. It's just a little too cheap for me. And even at 5 cents, it's only up 45%. So I'm focusing on the stock that I believe is the most obvious, which is going to be the leading percentage gainer. Now, something I always like to remind you guys of is the fact that retail brokers want their customers to trade. The more you trade, the more money they make. Now, even with commission-free brokers, they make money on your order flow. Here's the thing with these penny stocks. With these penny stocks, people are buying a lot of shares, and the money that they get paid is on a per share basis. So they're going to make more money when you're trading a 20-cent stock than if you're trading a $200 stock. So what do you think their incentive is going to be? It's going to be showing you the penny stocks that are moving, because this is where they're going to make money. The more trading, the more money they make. And so I have found that the leading percentage gainers each day, they get a lot of attention. They get attention in the media. They get attention from brokers who are emailing their clients or their customers, whatever you call them. These are the stocks that are moving today. These are the top gainers, top gainers, top gainers. So I always want to be focused on the top gainers because those are the stocks that are going to have the most attention. More attention means higher volume, and that is going to increase the imbalance between supply and demand, which means the move is going to get bigger and bigger and bigger. Okay, so on NSTG, the way I found the stock was by using the scanner. Okay, so now I've found the stock. How do I choose my entry? Where do I want to get in? Where do I want to get out? This stock has already done one pullback. So if we look at the chart right down here, this is a candlestick chart, and you can see how the stock has been increasing in value. The move is moving up. So we have these candles going up right here, and then this is what we call a pullback. This pullback occurred at about 17 cents a share. It then squeezed out of that pullback and moved even higher. And it formed another pullback right here at about 19 cents a share. This is where I bought it. I bought it right here as it was breaking out of that pullback. So for those of you who are a little bit newer, to make sure we're all on the same page, I'm just going to show you a little bit of the anatomy of these patterns. Okay, so what I like to see is the stock making a quick move up like this, long body green candle, and I like to see it's on high volume. At this time, as the stock is moving higher, each time it's making a new high and going up, 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 the stock is going to be hitting stock scanners, just like this one here. And it's going to be moving up the scanner as the percentage gain increases with each tick that as the price goes up. So as the price goes up, now people are watching it. More volume's coming in because more people are paying attention. It continues higher here before we have a pullback. Now, the first pullback is generally formed by people who were in before who are taking a little bit of profit. There are some people who will short these stocks. Shorting is when, and let's say this is at the 17-cent mark. Shorting is when you sell the stock and you profit when it goes lower because you buy back your shares at a lower price. However, let's be honest, the most you can make shorting a stock is if it goes to zero. So if you're shorting a stock that's priced at 1 penny a share, it's like you're shorting it basically at the bottom. So shorting a stock at 10 cents, 15 cents, you're still shorting a stock that's basically at the low. You have so much more risk that it goes to 50 cents or 75 cents or $1 or $2 or $3 a share, and a much higher likelihood that it does that than it goes to zero. So the risk to reward just isn't there. So although there will be some people that short these penny stocks, it's not going to be as common. All right, so we get the pullback, and then what I look for is I consider this to be a wave. All right, so we have a wave here, and I'm looking for the next wave back up. So what I'm actually going to look for is the first candle to break through the high of this previous candle. This is called a candle over candle formation. This green candle broke the high and went over the previous candle. This for me is a buy signal, which means I'm a buyer right here at this price. So I'm in right there with my buy order. Now you might think, okay, Ross, all right, so now I'm understanding why you got in, roughly speaking, let's see. So we had our first pullback at about 17 cents, and then the second one was at 19 cents. All right, so let's change the whiteboard. So let's just change this to 19 cents. All right, so I'm in at 19 cents a share. All right, and let's remember, I bought 5,000 shares, which was pretty much the most I could afford, right? Times 20 cents a share is exactly $1,000. But as we know, I got filled at 0.1969. All right, so 1969, that was my fill. All right, so I am basically all in on this stock. And some of you might think, wait a second, you just put the full $1,000 on this stock? You could have lost all that money. Not exactly. Let's think about what my max loss actually is on that type of trade. My max loss is the low of the wave. So what was the low of the last wave? Because that's my stop loss. All right, so let's pull up the charts and take a peek. So the low of this last wave was, well, it wasn't even 18 cents. It was just above 18 cents. It was about, it was above 18 cents. It was about 18 and maybe 18.4. Approximately, I don't have the exact, but it was approximately 18.4. So the stop loss here is 18, we'll call it 18 and a half cents. And my entry is just under 20 cents. So 19.69 approximately. All right. So what I'm risking here is just over 1 penny a share on 5,000 shares. Essentially what I'm risking on this is less than $75. Okay. So that's my total risk on the trade. Now, in a perfect world, this stock is going to squeeze up to 25 cents, 28 cents, 30 cents, 35, 40, and it's going to go higher. But if I see any sign of weakness, I can always just get out. Different traders have different schools of thought on this. Some traders, they'll say, I'm going to get in, I'm going to set my stop, and I'm not going to look at it. I'm either going to get stopped out or I'll come back and I'm still holding the position. I don't really like doing that. The reason I don't like doing that is because a lot can happen from the moment you press the buy button until you eventually potentially get stopped out. Just for instance, you could have the stock that actually makes a fantastic move. It could go from, you could be in on this pullback right here. It could go from 19 cents up to 25 to 30, but you set your stop way down here. This was your stop. And then it could come all the way back down and stop you out. Well, obviously you don't want to just get up and walk away. Now, could you set what's called a trailing stop? Trailing stops are popular. So a trailing stop is when you get in, so you buy the pullback and you get in with, let's say in this case, a 5-cent trailing stop. So a 5-cent trailing stop means that your initial stop is 5 cents below your entry, minus 5 cents. But every penny that the stock moves up, your stop moves with it. So if it goes all the way up to here like this, where's your stop go? 5 cents below the high. It's always 5 cents below the high. That's why they call it a trailing stop, because it's trailing as you go higher. So then if it finally drops down here, you're out of the trade. Boom, you've got your profit. This is a great strategy for someone that wants to take a trade, but is not able to monitor the trade all day long, with one exception. You cannot use stop orders pre-market. Okay, so the market opens at 9:30. That's the ringing of the bell on Wall Street is at 9:30 a.m. Eastern Standard Time. But pre-market begins at 4 in the morning. And so from 4 a.m. until 9:30 a.m., you can actively trade. So wait, what time was this trade? We could check the time. It's actually right here, about 9:33, 9:34. So on this trade, I could have gone ahead and set a trailing stop. But on any trade that is pre-market, a pre-market trade, you can't use trailing stops. It doesn't work. Now, there's one other problem with a trailing stop. The other problem with a trailing stop is that when you're finally selling, it's when the stock is going down. And it's easier to sell when a stock is going up because you're taking profit into strength. When it's rolling over and it's selling, you're trying to sell at the same time as everyone else, because now it's obvious that the price is coming back down. So selling as it's dropping, well, you're not going to get as good of an exit as if you had sold into strength. But on the other hand, if it keeps you in the trade a little bit longer, that's okay. So trailing stops, valid. Using just a regular standard stop order, not great. I would rather monitor the trade. So in this trade here, I've got $1,000 in the account, as you know. For some of my previous challenges, I was using a small account, well, the same account, but I was using leverage. One of the rules with the broker that I'm trading with is that you cannot use any leverage on stocks under $5 a share. The way leverage works is that when you deposit $1,000 into the account, I actually have times 6. I have $6,000 of buying power, which means if I saw a stock that was $6 a share, I could actually buy a full 1,000 shares of it. And if the stock goes up to $660, I'm up $600, right? That's my profit, $600 right there. So I could actually grow my account by 60% in one day, even when the underlying asset that I traded only went up 10%. That's awesome. But this is a sword that cuts both ways. If I get in at $6 and it goes the other way, drops to $540, then I'm down 600 and my account's down 60% in one day. In any case, using leverage is risky, but it can allow traders who have experience, like myself, to grow an account much faster. However, there is no leverage on stocks under $5. And so, of course, this stock price at 20 cents, I have no leverage. So although the total profit that I'm going to make on this trade is not going to be as high as I would have made trading a $5 or $6 stock, relatively, since I'm not using any leverage, it's still a pretty good return. Okay, so I'm in the trade. We bought at, let's see, I got in at 1969.1969, and my stop was just about 18.5 cents. As it squeezes up right here, I take half off the table. I took half off the table here just to be a little bit safe. My account literally has $1,000 in it. I wanted to book some profit. So by taking a little bit of profit, I now have realized a gain of $83.88. Now the trade's not closed. I'm still holding 1,250 shares, but I'm taking a little bit of profit off the table. Obviously, if I was using a trailing stop, I would still be holding the entire position, but with a 5-cent stop, I wouldn't get out until it was back at break even. And on a trade like this, I really need to be pretty aggressive about locking up my profit. The fact that it went all the way to 26 cents, I was impressed. I'm taking a little more off the table here. There's 27 on the offer. So what I'm doing is I'm actually selling my shares at the ask price right here because I want to make sure I get the best fill. So I'm not selling on the bid as much as I'm selling on the offer. So still holding 500 shares, 528 shares. I'm up right now $120.42. That's not bad. That's a decent little trade, but this is an example right here of that big red candle. This is where people start bailing out. The problem with this is that all of a sudden we say the bulls take the stairs and the bears take the window. So we have this nice slow increase in price, and then the bears jump out the window and we get this big drop. We don't like seeing this, but unfortunately it happens. And so that probably did take out a bunch of trailing stop orders and live stop orders. It drops down and then ends up bouncing back up. I take it all off the table for $129.24, which is a 12% gain on the account. That's not bad for day one of a small account challenge. Realistically, as you well know, the average mutual fund will be lucky to return 10% in 1 year. So for me to be able to do that in just one day is fantastic. In fact, I just beat the performance of many hedge funds, but I did it with, of course, a very small account. So what I've now done is I've changed the number of decimal points to 4. So now we can see what the price looks like. And this is where you're actually visually seeing how it trades down to the 1/100th of a penny. So you've got orders here. If we pause this just for a moment, it's not 21 cents by 21 cents. It's 21.08 by 21.29. So it really is trading down to the fraction of a penny. Now you've got 54 million shares of volume. The best thing about this stock is that it's very liquid. It was easy to get in. It was easy to get out. I didn't have to worry about getting trapped or getting stuck. In terms of a profit to loss ratio on the trade, given that I was risking $50 to $75, making $129, not as much as I would have liked to have made. One thing I'll say about this is that the float being 33 million shares is a little higher than I'd prefer. So what I'd like to do now is I'm going to back out of my live trade from today. Let's look at the chart from NSTG. I'll show you how high it actually went today because it had this initial squeeze, which is where I got in, this initial move right here, where I got in at 19 cents, just under 20, it goes up to 27, it pulls back down to about 18 cents, and it ends up holding support, and then it made another move higher. And it ended up squeezing all the way up to about 38 cents a share. This stock was up over 200% at one point today. This is a phenomenal move. We love seeing this type of volatility. This is really great to see. So if we look at the chart, you can see that there's some levels of ascending support. I like to draw these trend lines. These trend lines help me visualize areas where I could potentially be a buyer. Ultimately, I want to buy as close to support as possible. When I get in close to support, I'm risking less. Let's look at MLGO from yesterday. This stock, MLGO, yesterday made an exceptional move. So right now it's at 64 cents. But if we look at it yesterday, we get this chart a little bit bigger and we scroll back, you're going to see that this stock yesterday went from, let's see, so it actually hit a low the previous day of about 39 cents a share. 39 cents is a little higher than I thought. And it ended up squeezing all the way up here to a high of over $1. Let's see, it hit $1.69. This is an incredible move. Now, this was actually one of my big regrets yesterday because I had it up at the open and I had an order ready to go at 95 cents and I actually sent the order and it did not fill. So I didn't get any shares filled. This was right at the open at 96 cents and I didn't want to chase it. And so I was just like, well, I'm gonna focus on something else. The problem was I was trading in my main account, and I had a lot of yesterday the market was crazy. We had so much stuff moving. I just sort of had my side account here. I tried it, but it didn't get filled. And I was like, I just need to focus on my main account today. So anyways, it ends up going from 96 cents, squeezes all the way up here, halts multiple times. This was an incredible move. These are the types of stocks that can certainly allow a trader, a day trader with a relatively small account, to grow the account quickly. So it's important to differentiate the type of penny stocks that have the potential to make this type of move from the ones that are really junky and aren't going to go anywhere. Now, the float on this one actually is 11 million shares. So still a low float, and the float comparatively is a third of the float of the one that I traded today, NSTG. So when you have a stock that has 1/3 of the float, and by the way, so the volume on NSTG today is currently 350 million shares. MLGO, the volume on MLGO yesterday was 129 million shares. I think that is very telling. On 129 million shares, less volume, MLGO made a bigger move. It's because it required less demand due to the very low level of supply. In the case of NSTG, it requires 3 times more volume to create the same degree of imbalance between supply and demand. So this is like a moving calculation that, as an active trader, you will get this sense too. You start to realize which stocks have the potential to make big moves and which ones just, it's not going to happen. Now, if you want to learn more about the strategy that I trade every single day, I have pinned to the top comments and put a link in the description where you can download my small account challenge strategy PDF. It's a PDF that documents the strategy that I trade whenever I'm in a small account. I prefer to trade stocks that are between the $5 and $10 range because I can use the leverage with my account, and by using leverage, I can grow the account a lot faster. Having said that, as today's case study shows, there is nothing wrong with trading lower price stocks. In fact, even though the total profit that I made today is not the biggest day I've ever had on day one of a small account challenge, considering I didn't use any leverage, this was probably the most I could have made with just $1,000. I needed a stock where the underlying stock actually went up 12% in order for me to make 12% on the account. You know, it's cash. It's cash for cash. That's how much I was able to buy. There's no leverage. Now, as part of my small account challenge, I had said every time we cross over 10,000 new subscribers on the channel, I'll reset the account back to $1,000. So make sure you hit that subscribe button. I hope you hit the thumbs up. Once we cross over 10,000 new thumbs up in this series, guess what? I'm going to upload a deep dive breakdown of how I use level 2 to time my entries and my exits. So make sure you guys hit the thumbs up. I hope you subscribe to the channel, and I will see you for the next episode where I will be reset, most likely back to $1,000, and I'm going to try a slightly different strategy. I've tried small caps. I've tried penny stocks. What's coming next? Well, you'll have to stay tuned to find out. So I'm looking forward to seeing you for the next episode of the Small Account Challenge. And if you made it to the end of this episode, hey, check out this upload that YouTube thinks you are gonna just love.